Welcome to Kitchen Table Finance.
Hello and welcome to the Kitchen Table Finance podcast. I'm your host, Nick Nada, without my partner in crime, Mr. David Shotwell today. But lucky for our listeners, we have a fantastic guest and a great topic. So I'm super excited about that. Would like to welcome Matt Cooper to the Kitchen Table Finance podcast. Matt works for Matthew Accounting, owns Matthew Accounting, and is a local certified public accountant here in the DeWitt area. And we are going to have a robust conversation about the big, beautiful tax bill that's kind of changing your world, I'm sure, Matt. So with that, how are you doing today?
I'm doing good. Thanks for having me on. I appreciate that.
Wonderful. So I know you've got a little bit of a breather here before the next tax deadline. It seems like, there's a tax deadline every other month nowadays. So I'm really grateful for you jumping on the show. And I know that there's some tax changes that are coming. And so we really wanted to dive into some of the details around that and give our listeners some things to think about as they're going through and doing tax planning and thinking about these things and how they're going to impact them. But before I do that, I did want to just kind of get to know you a little bit more and maybe tell our listeners a little bit about how you got into the accounting world and maybe a little bit about your firm.
Again, my name is Matt. I'm the owner of Matthew Accounting. Started about 18 years ago, and I've always had an interest in personal finance and accounting and taxes. Graduated Michigan State with a bachelor's degree. Went on, got my CPA, got the experience that we needed, and always knew I wanted to work for myself. So 18 years ago, started our firm just with myself, helping individuals with taxes. And we've since grown to about 10 people, depending on the time of year. And we specialize in helping people with their taxes, their accounting, and really being proactive about saving more of their money. And so I'm happy to be here today to talk with you about the new big, beautiful bill and how that might present some tax opportunities and what changes people might be looking for.
Yeah, that's fantastic. You must have started your own business when you were like 20, 22? That's crazy.
Yeah, it feels like that. Time flies. Been 20 years. So yeah, mid-20s when I started. It was a grind in the beginning, but very grateful for that work now.
Yeah, that's fantastic. And I love that you're passionate about helping people with personal finances, especially on the accounting side, because it seems like there's just not many of you out there anymore. And it seems like the ones of you that are out there maybe don't really like it all that much. At least maybe that's my experience. So
Yeah. I've seen that on my end too, right? The accountant that has put in the long hours over tax season and over their life has just gotten to the point where they're burning out a little bit. So yes, I am grateful to be here and be engaged and ready to help people.
That's awesome. Do you guys have any, do you specialize in anything particular in your firm, or what would you say is your kind of focus?
Yeah, we specialize in back office accounting for successful small businesses. And we also help individuals with their annual tax return. Nice. We have a few industry niches that we work in. One of the primary ones is restaurants. We help a lot of restaurants with their back office, with their accounting, with their payroll, but other successful small businesses as well. Dentist office, medical professionals, physical therapists, chiropractors, those types of clients are who we specialize in helping with their accounting, bookkeeping, payroll, and tax. And then each year we help a host of individuals with their annual tax return, and during the year with their personal finance, their planning as far as tax returns go. Okay.
Yeah, that's awesome. It's funny, with all the different entrants into the tax world, people, some people assume that they can do it on their own through TurboTax, and I'm sure they can, right? Not everybody that uses TurboTax gets arrested for tax fraud, but it's just one of those things where it's so much stress involved, having someone that's an expert in it that can walk you through all that stuff. I know for a lot of our clients is super helpful. So I'm sure you guys are experiencing that on your end as well. Is there anything in particular now that you're working on, anything new going on that you want to share with our listeners? Or is it pretty much just trying to learn what the big, beautiful bill is going to do to you?
Yeah, that's the big thing right now. That's the big thing right now is the big, beautiful bill. There's quite a few changes in there, quite a few opportunities for people to plan. So what we're heavily focused on at our firm is learning where the challenges are, where the opportunities are with that bill, and how can we help our clients plan for that.
Yeah, for sure.
Yeah.
Love it. Well, with that, that's a great transition, Matt. Let's jump right in and talk a little bit about that. So one of the things I know that was on our minds and our clients' minds was what's going on with tax brackets in 2025. Are we going to revert back to where we were before the last implementation of tax changes? So what happened with that?
Yeah, they implemented tax bracket changes when President Trump was elected, and those have been made permanent now. So
Okay.
at least in the midterm, we're not going to see any changes in the tax brackets. Those are made permanent in the law. It would take a different law to change those later.
Gotcha. So no like cliff sunset like they like to do, and not that they won't change, but they're not scheduled to without
that's
somebody
a good point.
acting on it. Yeah. Okay. Cool.
Yeah.
One of the big changes that I know that our clients kind of have been dealing with over the past couple of years, I'm sure you've seen it as well, is this higher standard deduction that we got. Can you walk us through if that's staying or what that looks like going forward?
And same as the tax brackets, the higher standard deduction has been made permanent. They are adjusted for inflation now going forward, so they'll increase appropriately over the years with the inflation adjustment. But they're made permanent, and those are designed to make it a little easier for people to file their taxes. A little less likely that you'll itemize your deductions, a little more likely that you can take a larger, more beneficial standard deduction, and those are sticking with us.
So interesting. We've seen a lot of people, at least on our end, go from itemizing to not itemizing. Are you guys experiencing? I think I heard something where it's like now like 80% of people take the standard deduction. I don't know where I got that stat from or if it's true, but I'm curious what your experience is. Are the majority of your clients taking standard deduction, or are they itemizing still?
It's a good question. The way we look at it is our clients are a little different probably than the average taxpayer.
Yeah.
And so typically if you're coming to our firm, it's a little more complex. So I would say a higher percentage of our clients are itemizing. However, I think you're onto a trend. Less are itemizing this year than they were prior to these changes. So we are seeing less itemization among our clients, although many of our clients still do itemize.
Yeah. So a lot of our clients are very charitably inclined. We do a lot of qualified charitable distributions every year for people who are that age. But one of the things that I saw in this bill that kind of benefits everybody who's charitably minded is some changes to charitable deductions, and even potentially for those of us who are taking the standard deduction, maybe being able to deduct some of our charitable contributions. You want to tell us about that change?
Yeah, that's good. I'm glad you brought that up. Charitable contributions did change, and there's 3 or 4 different ways that they change. But one, as you mentioned, was the what we call tax preparers call above the line deduction. So even if you're itemizing or if you're not itemizing, you're allowed to take a $1,000 deduction for a single person or a $2,000 deduction for married filing jointly. If you actually made contributions, now it's just not a standard deduction, but if you made charitable contributions, you can take $1,000 or $2,000 right off of your adjusted gross income rather than itemizing. So that's a new change that's welcome. A lot of people were donating that amount but not getting the credit for it, and it'll be nice for them to get credit for it moving forward.
Yeah, and a pro tip, if I will, a lot of people, because we went to the standard deduction, stopped keeping track of that stuff.
Yeah.
So probably something, if you're making those contributions, you're going to want to get receipts for, right?
Absolutely. You know what? We've seen this before. Sometimes when there's natural disasters around the world, they'll implement this, and people will come in our office and say, "Yep, just give me the standard, whatever it is for the deduction." And it's not quite like that. I think you had a good point. You still have to keep your receipts. You still have to make the donation. So yeah, get back in the mind of keeping track of those for at least the first couple thousand.
Yeah. And I believe, if I'm not mistaken, that starts in 2026, not in 2025. Does
Yes.
that sound
Yeah.
right? Okay.
I believe so too. Yeah.
Are there other changes to the charitable contributions going on?
Yeah. They put a floor in there. So there's a 0.5% of your adjusted gross income is excluded. So you have to donate above 0.5% of your adjusted gross income before itemized deductions start counting.
Gotcha.
Now that's not the above the line $1,000 or $2,000 deduction, but if you're going above and beyond that, then you have a floor of 0.5% of your adjusted gross income. For those of us in the higher income bracket, let's say you're being taxed at a tax rate of 35% or higher. Itemized deductions now are limited to only 35%. So even if you're being taxed at a higher rate, like 37%, then you still only get benefit of a 35% deduction.
Okay.
That's a unique and technical update, but it might affect some of the higher income taxpayers.
Yeah, sounds like a little bit more tax planning going on when it comes to charitable contributions and making sure you're hitting the spot that you want to be in. And I know with the changes to the standard deduction, we've got a lot of people who are, potentially batching contributions into one year or using something like a donor advised fund to get all those contributions in, even if they're not going to go out right away. So it sounds like that's sticking around a little bit.
It is. And I think that's one of the bigger planning opportunities for charitable contributions is that donor advised fund. Yeah. I'm seeing more and more of my clients use those and benefit. I just had a client put a significant amount into a donor advised fund, and then their company will match their donations from that fund to their charity. And so they were able to get a good tax break and double their donations to the charity. So that's a good deal.
That's awesome. Yeah. I've never heard of that through a donor advised fund before. That's pretty cool.
Yeah, at first they thought that was not going to work, but then they said, "Oh no, our executives are doing this as well." And so I think it's worth checking out for people who have that opportunity.
Yeah, very cool. So I know that one of the big things for our higher earners is the SALT limit. Do you want to what is SALT and what's changing with how salty we're getting on our taxes?
Yeah. SALT is an acronym that stands for state and local taxes. And it is typically an itemized deduction. And when the tax bill passed several years ago to simplify the code, the higher standard deduction, what they also did was they limited some of the itemized deductions. And SALT, or state and local income tax deductions, is an itemized deduction. And they limited that to a $10,000 cap. $10,000 is all that can count towards your itemized deductions. However, in this new bill, 25 through 29, it's temporary, so it will phase out. They raised it to $40,000. So It's a significant increase for some of the people who are itemizing in higher income tax states. That's where you're going to see most of the benefit there.
Sure. So you want to just give us a brief rundown of like what gets included in that state and local income tax? Is it just...
Yeah, typically your big one's going to be your income tax that you're paying to your state on your wages.
Gotcha.
Yep. That's one of them. You do have an option to compare that to the sales tax that you paid in your particular state and take the one that's higher. So occasionally, you're out buying a car and you're a retired person, you may pay more in sales tax than you do income state tax. So that's an option. City taxes, in our area, East Lansing, charges a tax, Lansing charges a tax. Those are included in there. And so what you do is you add all those up, and it used to be capped at $10,000. Now it'll be capped at $40,000, and that counts towards part of your itemized deductions.
Okay. Property taxes, does that get included in that?
Yep. Property taxes are another one. Good reminder there. Property taxes that you pay, as well as in Michigan and other states, off and on, it's your car registration is actually a tax on the value of your car. So you can include that in there as well. Yep.
Gotcha. Cool.
It was a lot of people met the cap at 10,000. So they were used to not keeping all the receipts for everything.
Right.
Now that it's 40,000, it's again, like those charitable donations, you might want to start keeping those receipts just to see if it works.
Yeah. So one of the newer, more obscure pieces, at least in my opinion, when you're talking about going out and buying a car, is interest deductions on cars are now going to be tax deductible. Did I get that right?
Yes, you did. I was not expecting that. Yeah. Like I said, I've been doing taxes for 20 years, and back in the beginning, we'd have some of the the older clients come in and say, I can deduct my car interest. I'm like, no, not since I've been around, but now you can.
Yeah.
There's a limit up to 10,000, and it has to be a new vehicle, and you can deduct up to 10,000 of your interest paid. Okay. And that's not a new itemized deduction that you can take, and you can add up all these itemized deductions and see if they're more beneficial for you than the standard deduction. I think in theory, my thought at least is they took away some of the electric vehicle tax credits. Mm-hmm. Those are sunsetting, and so this is a way to help, but kind of spread it out over the whole auto industry and not just for the electric vehicles.
And then I think the requirement for that, from my understanding, is the car has to be assembled in the U.S. or something weird like that. So it doesn't necessarily have to be a U.S.-owned company. I'm not sure exactly what those. I'm sure somebody on the internet has already figured out what that means and what cars qualify and don't qualify. But I believe that was the intent, was to boost American manufacturing. So. Something to look out for. And I can even do some research and maybe put that in the show notes too when we're done here. Some of the questions that we're getting are around some of the things that people hear on the news and from the president, and not necessarily, in the bill. And I think the big one, especially, for our retirees, is did taxes on Social Security go away? Because that was one of the the big things that people heard. Well, I'm not going to have to pay taxes on my Social Security anymore. And my understanding is that's not necessarily true, but there is a benefit for seniors in this bill, correct?
Yes, that is exactly correct. As a bill gets passed, it goes through multiple different phases. Oh, yeah. And some of that was in there, some of it's out. And so when people talk about it, you really don't know until you see the final bill. But Social Security remains taxable the same way it was before. However, they did give an additional temporary deduction for seniors in order to kind of offset the effect of taxing their Social Security. Mm-hmm. So there's an additional, let me look here.
I think it was something around $6,000, I believe.
Yeah, it's a $6,000 deduction for an individual and a $12,000 deduction for joint filers. Mm-hmm. And it does phase out with income limits. So it starts to phase out when your modified adjusted gross income is $75,000 for a single person, $150,000 for a joint filer. So it's nice for if your income is below that, and a lot of it's Social Security, but you still are paying some tax. This will help offset that, and that was the design of this. Yep. Let me look real quick. It does phase out, though. It's not one of the permanent changes. It is something that's going to phase out. So it's one of the things you can count on for a few years, but not permanently.
Okay. Yeah. Another one of those hurdles as we're gearing up for tax planning season of, trying to play the game of getting under that number or like getting up to that number without going over when you're talking about distributions and things like that. Because it's a pretty decent, $12,000 is a pretty good credit for sure.
Yeah, for sure.
So I hear that you're no longer going to have to pay taxes on any tips that you receive. So I guess that's my question. And the follow-up to that would be, can I get paid in tips? Is that allowed?
Yeah, those are two good questions. Yeah. Yep. There is a carve-out in this bill for not paying federal income tax on a portion of your tips. Now, it's not all of your tips. Tips will still be reported on your tax return. However, there's up to a $25,000 deduction for federal income tax, right? You'll still pay Social Security tax on that, but on the tips, there's a deduction for $25,000 for that. And can you get paid in tips? That is the question. Like, my financial advisor is great. I'm just going to tip them, right? But no, it has to be customary, right? It has to be a customary process in your line of work. So converting, ordinarily wages to tips isn't going to work. However, if it is custom for you to get tips, that's a deduction that'll help you for sure.
Okay. Yeah, I'm curious to see all of these bartenders, waitresses that get cash tips as to whether or not they're going to try to claim them now.
The idea is that you're supposed to claim your tips, right? That's the rule. But this isn't much of a benefit if you're not claiming all your tips, right? The benefit here is that you're claiming your tips. And so claiming them means you'll pay the Social Security tax and the federal income tax. Then this deduction will take away the federal tax, but you'll still be paying Social Security tax.
Gotcha.
It's a great deduction for people who get tips, but it might not be as valuable as you might think by reading the headline.
Yeah. And I believe also phase outs when it comes to that.
Yeah. The deduction phases out over 150,000, 300,000 for a
Gotcha.
joint filer.
Lots of tips. So the other part of this that we're hearing a lot of is that your overtime will also not be taxed anymore. So I'm curious how the bill came down on deciding what that would look like.
Yeah, very similar to tips, right? There's a carve-out for an individual that works overtime, right?
Yeah.
And they can get a $12,500 deduction on their overtime premium and $25,000 if it's joint filing. And
Okay.
essentially, my first thought was like, oh, any overtime pay is not taxable, but it's not really any overtime pay. It's just the premium, the half that you get 1.5 times. Right?
Gotcha.
So that is not, you're allowed to take a deduction for that, right?
Mm-hmm.
And it's not like you can just get paid hourly now and get overtime, right? You have to be an employee that qualifies for overtime in order to get this deduction.
Gotcha.
So I get some business owners that are running their business and they may think, well, sure, I'll just have a salary and then to get, pay my overtime because I work a lot. But you have to be qualified for overtime in the first place with the labor laws, and then you can get access to this deduction.
Gotcha. Makes sense. There's always everybody's always looking for the loophole, but they're usually pretty good at finding and closing these things before too long. So the other thing you alluded to a little bit, but the clean energy electric vehicle tax credits are going away, correct? And do people still have the opportunity to do something before the end of the year here, or is that gone for good?
Well, EV credits are going to expire at the end of the quarter. So September 30th, 2025 is when the EV credits for electric vehicles expire. Then there's residential energy credits that expire at the end of the year. That, if you're going to be doing some improvements on your home and you want to get new windows and you want to get a credit for that, that's going to expire at the end of this year. And then there's some larger credits that expire in phases over the next couple of years. But what this really does is it signals a shift in policy. So they're switching away from kind of incentivizing people to do this energy efficient decision making and just switching that off from the tax bill.
Yeah, don't buy an EV, buy a big gas guzzling car and finance it so you can write off your interest.
That's the idea, right? Another way to look at it is we're not going to give you credit for buying an EV. We're going to just give you credit for buying any new car.
Yeah. You've been around long enough in the last 20 years to see a few of these tax changes. What would you say surprised you the most about this one in particular?
Well, it was a little bit surprising, the EV stuff. I mean, the tax changes were directly related to the new president and his approach. So, I mean, you can look at what he likes and what he talks about and kind of see what's coming. But the changes in the EV bill were surprising to me. I thought that those would continue for the cars is what I thought. Maybe not for the homes and all that stuff, but it turns out that that's not in there. So that's going away, and that was a surprise to me.
Yeah. So one of the things I think about as we're talking through this and going over it is the first Tax Cuts and Jobs Act, I think 2017. Is that right? Somewhere around there?
That's my memory too, yes.
Yeah. So I think like the whole premise, at least what was being spoken, was that, filing taxes is going to get easier and simpler. And it seems to me like this is a shift from that because pretty much everything we talked about has a different schedule, has a different phase out. It's only going to last so long. I'm curious what your thoughts are. You've been through a few of these tax changes. What's the best way for people to prepare for this and kind of plan ahead, knowing that, we've got some changes now that are going to be around for a while, but ultimately there'll be another change at some point in the future, you got to imagine, right?
Yeah, that's been my experience. It's either a change of the presidency, change of the policy, or some type of economic downturn, a banking crisis, or just a recession. So you can expect more tax changes in the future, right? Mm-hmm. But for now, we kind of have a little bit of solid ground to stand on. We kind of know what the rates are. We kind of know what a few of the rules are going to be for the next 2 or 3 years. So my advice is to take advantage of what you know about now and do some planning in that regards, whether it's, you want to bunch your itemized deductions, use a donor advised fund. You want to take advantage of some of these carve-outs for individual donations. But the idea is stay actively engaged with your financial advisor, with your tax preparer, or, if you're doing it on yourself with TurboTax, just stay actively engaged with reading, learning about it on your own, so that you can plan ahead for the next 2 or 3 years, because you have a decent opportunity to use these changes to your advantage.
Yeah. I think that's so true. And, we're doing a lot of this work with our clients right now. And it's, nobody likes thinking about taxes except for maybe you, Matt. But it's like, we do our taxes in, April if you owe money, in January if you're getting money back, right? But then we just forget about it until the next year. And really, like, now is the time to do the planning, because there's a lot that you can do between now and the end of the year. Where if you wait until after January or December 31st, you're kind of locked in, other than a couple small things that you might be able to change.
Great thought. Be a little bit more proactive with the management of your taxes, your tax planning, rather than reactive, right? So I think we have some opportunity now to the end of the year, see what changes are out there, see what might apply to you, and see if any of them present a good opportunity for you to save.
Yeah, this is very helpful. This stuff can be overwhelming, so I love how you broke it down for us. And appreciate you coming on the show. Would love to, if you're willing, is there a way for our listeners to reach out to you if they have specific questions or want to get a jump start on some tax planning?
Yeah, absolutely. Appreciate that. Visit our website. There's contact information all over our website, but Matthew Accounting is our firm. We're located in DeWitt, Michigan. Feel free to reach out, email, phone call. I'll be happy to help.
Love it. And I will put that in the show notes for all of our listeners. So make sure to check that out and reach out to Matt to get a jump start on making sure you're prepared for the big, beautiful bill, and working with someone who loves talking about and thinking about taxes. You are few and far between, my friend, and it seems like there are less and less of you out there. So I would highly encourage people to jump on the chance and reach out to you and your firm and see how you can help. With that, I truly appreciate you being here. I know a little bit about taxes, enough to be dangerous, but it's nice to be able to run through some of these things with someone who lives and breathes it every day, because it is a changing landscape and something you definitely need to keep on top of. So I appreciate you for that and for coming on the show. And to our listeners, if you have any questions, you can reach out to info@srbadvisors.com. We would love to answer any of your questions. And if they're tax related, I'm sure Matt here will give us a hand in making sure we get the right answer before we get it out to you. So with that, thanks for everything, Matt.
Yeah, thank you, Nick. I appreciate the opportunity. It's been a pleasure.
You bet. Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Cedia Media production.